Hello, everyone. This is ALKHEDR. I'm head of research department at Equity Group. I would like to thank you all for attending this session, and I hope I can provide you with useful information. You can use it while you are trading till the end of Q4. So first, I'm going to start introducing Equiti. Equiti is a multi-licensed broker, a fintech company, actually. We have the online trading brokerage besides the PSPs, payment solutions, and physical trading, physical commodities, and so many other trading and financial instruments that we are taking care of. So, this session is like very short, guys, and it will have this kind of information that it will guide your way till the end of the year, and what is the both sides of the monetary policy and fiscal policy of the global economies, basically the major economies, developed countries, US and UK, Europe, and also we're gonna provide some information about the Chinese economy. I will start first with the US economy. As you know, guys, some major change happened by the 20th of this month, September, when the Fed decided to keep their interest rate unchanged at the 5.5%, between 5.25 to 5.5%. But what new about this was the tune. It was so hawkish. They are planning to increase interest rate even one more time this year. They still insist that their work towards bringing inflation to the target at 2% is the most important step by the Federal Reserve. And by this, it can explain a lot for a trader in the market. First, we're gonna discuss what they're gonna do, how they're gonna do this. They're gonna increase interest rate. Definitely they have to. Why? Because first of all, the inflation is still relatively high. It's a 3.8%. This is based on August print. So the recent reading was 3.8%. Yes, it might go down a little bit, but you need to look for two things. First, the GDP. There is a trend for the GDP. Anything below that trend, it means there is a contraction in the economy. Above that trend, there is an expansion. So far, the US economy is, let's say, performing below the trend. And this is very normal in the case of disinflation, because inflation is coming down towards the target. Still higher than the target, but it's going down. They are working on making inflation towards the 2%. This is a very difficult process. It will not happen soon. Especially, all the data that we receive, it's an old data. While they compile these data and bring it from the history, it takes time. And therefore, the decision is late a little bit. What we can understand, they will take their time with the high interest rates. How this will reflect into the market? First of all, you need to understand one thing. Hawkish tone, higher interest rate, it's bad for the stocks. But we saw like exception in the stocks, which is the technology sector and the AI. And we saw NVIDIA, how it rose so high to the level, they describe it in Bloomberg and Reuters, they describe it as a bubble, and it will burst very soon. But in my opinion, this is not a bubble that we can compare it to the 90s, the century before. No, it's something that all the economy is shifting into the AI sector. So it works exactly in the core of the new model of the economy, in the global economy, not only in the US. So I don't think this rally will stop anytime soon. It will continue. And Specifically, I will say, since the registering of stocks from the 1960s till today, S&P 500, they saw red closing 13 times, all right? 13 years out of 70 years or even more, only 13 times that index, the S&P 500, closed in negative. And every time it closes in a negative, the year after is green, like it goes up. Guess what? Last year it was negative, and this year it should be green. And so far it's going even higher. I can say the NASDAQ will continue the uptrend till the end of the year, and it might even close above the 16,000. But let me also explain a few stuff about the Dow Jones and the S&P. They will struggle this month till November, actually, where it's like expected to increase the interest rate again. But they already did very well since the beginning of this year. What does that mean? It will close relatively close to the current level, 34,500 to 34,700 this year. I think we might close at this level. It might push a little down till November because everyone in the market as investors are a little bit, let's say, there is uncertainty in the market because they are increasing interest rate. They are increasing the cost of money, cost of borrowing money. This is bad for companies. And we are at a very high level. So far, we didn't get anything from the decision maker in monetary policy about stopping that tightening cycle. What does that mean? It's already expensive, and this is already gonna affect, and it will affect actually the businesses and the market in general. So that will reflect negatively on the U.S. Business, and it might also apply some pressure on the major indices, but it will stay resilient. As you know, we keep receiving from the Fed and the Jerome Powell, the head of Federal Reserve, messages that we might see weakness in the labor market and unemployment might a little bit increase as well. And this is very normal at the current level. Why? Because it's like, if you are increasing the cost of running business by increasing, for example, the interest rate and the cost of borrowing money, I will not bring new employees and I will not increase the salaries or the wages of these employees. Actually, I will think about cutting cost and lay out few employees from each company. That's why unemployment is expected even to increase a little bit towards the 4 to 4.2%. It's not logical to keep it at the at the 3.4 or 3.5, where this is represent the ultimate situation for the economy and ultimate situation for the labor market in particular. At the end, also cost of borrowing money, it means higher mortgage rates. Higher mortgage rates will push people to buy less, and we saw that through the drop in housing sector. Housing market, more declines, and this will continue, I believe, till the end of the year because there is no signal so far to stop their interest rates hikes. Moving quickly to the Europe and UK, well, let me tell you this. It's not happy days there at all. Situation is not good. Europe are struggling. UK in particular, they are into recession. You know what is recession? Recession, the economic definition of recession, when we have two quarters follow each other in a negative growth. All right? So when you have two negative quarters of a calendar year in minus, it means you are in a recession. And that's what happened already in the UK economy. Their inflation is still so high. It's above the 4.8%, which is still represent a very high level. And their interest rate at its peak at 5.25%, and I don't think they are able to increase interest rates anymore there. What does that mean? The next phase of GBP USD lower. I can say on the technical and fundamental analysis on that pair, we might even see levels below 1.21 to 1.20. This is by approaching the end of the year. On the other side, Europe is not a better situation there. The inflation is still very high, and the gap I will consider between the monetary policy in US and monetary policy in the Eurozone is getting wider. These guys are still aggressive with their interest rate, still expecting a higher interest rate, while Europe, they announced it clearly, it was the last time to increase interest rate at their last meeting. So the future is a stronger dollar, weaker euro, until inflation reaches to the target. Then we might see little bit progress on the Euro USD in the upper side. So far, I can say till the end of the year, we might see the euro below the 1.04 towards the 1.0360 to 50. You remember the scenarios between China and US, what they call a tit for tat, and this kind of aggressive tune between these two countries. The trade war is there, and we're gonna escalate even more. And the reason why? It's the semiconductors. Still is a big issue between the US and China, and we're gonna hear more about this issue with the Q4, especially while China is trying to defeat their slow growth. And also they have issues with their property sector, as we know exactly. And there is one thing you should know. If you keep interest rates so high in US, people can't borrow money. This is not good for banks. Banks will collapse. And believe me, when banks collapse, they don't do that alone. This is like a domino effect. It will spread, and we're gonna see more banks under pressure while we are at high interest rates. And who is the most affected country, I can say, with this struggle? It's gonna be China. And this will create and produce more, let's say, tensions between US and China over their trade balance. There is, as you know, a race over the microchips. There is a race over the metals and over the semiconductors. At the end of the day, I will not say it's a negative or a gloomy outlook till the end of the year, but we can say one thing only. I think there is a big change and shift in policies will happen by the end of this year, and people like central banks, they will start shifting their focus away from inflation and defeating inflation, because that mission will happen already and we're gonna reach to that target, and they will focus more on bringing back the growth of their economies. Thank you so much for this, for attending this session, and I appreciate your time. We have a very limited and short time. Again, I thank you for attending. We are at booth number 94. I can expect you guys to visit us there if you have more questions or you want to discuss more the offers that we have at Equity. Thank you so much. I appreciate your time.